Hello and welcome. There's been a sharp decline in the mid-cap and small-cap funds, causing a lot of panic amongst the investors. In today's Investors Hangout, which is brought to you by Aditya Birla Sun Life Mutual Funds and Value Research, we will be discussing as to how to handle this mid-cap mayhem. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
Now, emphatically, I'm going to ask you, how do we handle this mid-cap mayhem?
Keep calm and carry on. Don't panic, because panic won't help. These are the funds, which did very well, exceptionally well. These are funds, the small caps went up by 30%, gave you return of 30% every year on an annualized return over the last 5 years. Likewise, mid caps were extremely rewarding. And if you panic because they are down, the small caps are down 12%, median, the average, or the mid caps are down about 8%. I don't think this is a good enough reason to panic, because they are extremely rewarding funds. They still hold promise. You need to be a little careful about the kind of funds you invest in and managing your own temperament. Right. If you're an accidental, investor, you didn't know what is going on. You looked at the recent past performance, how many of these funds have done in the last 1 year, 2 years. You got interested and it has been rewarding. And suddenly you are faced with this 10% decline in value from the peak. But you did not, most investors did not invest at the peak. Most investors do their SIP. Somebody would have invested 6 months ago. Somebody would have invested a year ago.
Right.
They might be in for a disappointment, because if you haven't earned those 30% annualized return over the last 5 years, then your buy price may not be low enough. So very few investors will actually be sitting on losses. You haven't lost money. Most investors would not have lost money if anybody is investing for 1.5 years, 2 years. That apart, one should have a long-term view. These funds are still promising. They deliver you some very tangible benefits in terms of diversification, convenience, and never make lump sum investment. If you make a one-time big investment, you could be in for a disappointment. And don't invest your short-term money. If these two rules are in place, and if you can withstand the kind of decline that you are witnessing right now, you will be investing cheap. They prove to be extremely rewarding. They prove to be extremely rewarding not because they do well. Of course they do well over time, because small companies turn bigger, big companies become very big, and that is when you actually make a lot of money. And that requires time. It doesn't happen in 3 months' time. Stock markets do not generate, they don't create money.
Right.
When companies make money, stock goes up. That is why, keep calm and carry on, stick to your plan. And if you are an accidental investor, likely to need money in 6-8 months, goes down further, if it goes down further, you will be in difficulty, then by all means take your money out. Otherwise, stick to your plan, don't do anything.
But why is it so? Because both Sensex and Nifty have gone up and the stock markets have reached a new high. And as you mentioned, small cap has plunged 20%, mid cap index is down roughly about 12.5%. But why is it happening? Why is
this disconnect?
Yeah.
Just look at reversion to mean. If you look at 5-year return, Sensex or Nifty going up despite the significant jump in recent months. Still, the 5-year return on Sensex is 17%, or large cap funds will be about 18%. Small cap will be 30%, and mid cap will be 26-28%. Now this is substantial difference. The amount of money that you have made in small cap funds over the last 5 years is twice as much as the index. Yes, things where markets are cyclical. Different part of the market might be doing well at a certain point, and some part may not be doing well, and they catch up. And we have seen, Reliance Industry, TCS, the heavyweights of the Sensex and the Nifty, they have gone up substantially. And small caps, which because they did very well, they have gone down in value. I would not say corrected, as if that earlier was incorrect, as if no, not so, but they went up substantially. Some of them might be very richly valued. The price which went up, that going down in the interim is a very natural course of the market. And that is why you hire a fund manager. When you invest in a mutual fund, you are hiring a fund manager that make that choice for me. Build a portfolio, build a set of, buy a set of stocks for me, which will companies which will not disappear, companies which will do well over time. And if they go up, if something has actually delivered you 30% return over the last 5 years, despite this, after this decline, factoring in this decline as well, then 10-12% correction is all right.
Okay. So is this phase, the worst is behind us? And if not, then how long will it continue? Can you predict?
No.
No, nobody can.
No. You need to be an astrologer or a magician to be doing that. But no, and that prediction doesn't help. Even if you can predict, is it worth taking a chance, assuming that I can predict it well? No. I would say that make a plan. Make sure that you have the experience and the temperament to withstand that. If you are not, then go back to the balanced fund. You will still be able to derive 80% of the benefit. You don't have to necessarily invest in small cap funds. Invest in a small cap fund only if you can invest gradually and can withstand this 10%, 15%, 20%. This 10, 12, 15% is nothing. If you look at 2008, the best performing small cap fund of the decade, last decade, happens to be what was the erstwhile DSP BlackRock Microcap Fund. And DSP BlackRock Microcap Fund started little before 2008, and it went down in value by about 65-70% in 2008. Wow. And so if you invested 100 rupees, it became 30 or maybe even less. And then it made a major comeback and it went up by 100% in a couple of these years in between. So this is the beast. If you are uncomfortable, this 10-12%, 15% decline is nothing. Get used to it if you want to reap the reward. Yeah. What is important is that invest regularly. You are buying cheap. If somebody was investing at 30%, 30% leftover value, it is very hard to do that. Much easier said on Investor Hangout. But when you see that your 100 rupee has come down to 30, and that's the time when you are still investing your 5,000 rupee, it's hard, but if you are able to do it, it turns out to be the biggest contributor to your, the wealth building phase.
So what you said earlier, don't panic, comes into play.
Keep calm, carry on, don't panic.
Okay, in the current scenario, what would be the right strategy for the investor, apart from, of course, not panicking and, keep on investing in the mid-cap and small-cap funds for a long time now? Right strategy of an investor?
No, I would say that, investors should try and rebalance. If you have chosen to invest, generally speaking, as we keep saying, we keep emphasizing, keep, reminding investors that the best way to invest is keep it simple. So, first time investors should invest in a balanced fund. A lot of things happens there. The automatic rebalancing happens, into equity and fixed income. The portfolio itself is diversified. If you are going to be 100% equity investor, invest in a multi-cap fund. It will keep it, you'll be keeping it simple. One fund which will invest in large cap, mid cap and small cap as well. Now, if you have chosen to invest in small cap and mid caps, make sure that, it is not more than 20, 30%, 40% to your comfort, because all your plans should not be derailed. Or you should not panic, you should not be uncomfortable, you should not be in great discomfort because the market is crumbling. So decide your proportion. Make sure that it is 10%, 15%, 20% or nothing. Don't have small caps if it is causing you anxiety of extreme kind. Because if this kind of decline, if your 100 rupee becoming 88 causes great anxiety, then it's not meant for you. You are not
worth it for you then.
Yeah, you are not suited for small caps, however rewarding it may be. So this might be a point to check what you're most suited for. And maybe this is time to revisit what you were doing. Is it all right? If you are uncomfortable with this, maybe change your track, get back to balanced fund or go back to multi-cap fund. And if at all you have to invest in small cap and mid cap fund, have an allocation. Make sure you are rebalancing. If you have chosen to have 40% allocation to small cap, it will go down in value. Maybe invest more. Do your more SIP in small caps now. Because most investors actually chase recent past performance. You invest money in something which has done well in recent past. you should be doing the other way around. What has not done well, but at the same time, you should be investing your money in something which has not done well in recent past, so that you are buying cheap. At the same time, don't forget the basic rule: never invest lump sum. Do your SIP and invest only your long-term money, and ensure that it is diversified well enough, which happens naturally or automatically when you invest in a mutual fund. Do this, and don't watch your investment values every night. Don't watch it. Don't look at it closely every day. Kitna hua every day.
So, will you say that this strategy will hold good for the new investor as well? Or if you are a little tentative about mid cap or small cap, then don't get into it at all.
Don't get into it at all, because new investors, if you are getting uncomfortable with it, change track. This is a wake up call for you to find the right path. And there are appropriate paths. The balanced fund, the multi-cap fund, and the small cap and mid caps are meant for people. You can do well without investing in these funds. When you invest in a multi-cap fund, you are automatically investing 10-15% in small caps too. Just that it's not visible with clarity that you are not investing. When you are looking at too many funds of this narrow mandate, they look good and they look horrible too, and that is part of the game.
So what Dhirendra is saying is keep calm and don't panic at all.
Don't panic.
And invest regularly. So we move on now to the Q&A part of our program, and the first question is from Nirav. He says, I have 2 years time to reach my goal. Should I stay invested in mid-cap funds, or should I move my investment to large cap schemes?
Neither. But it entirely depends on how negotiable is the goal. If you definitely need the money 2 years from now, then maybe next 18 months, 2 years or 1 year time, take your money out gradually and move that money into fixed income fund. You do your SIP, and before you need the money, you should do your SWP. You should have a systematic withdrawal plan in mind. And so if it is for a non-negotiable goal, if that money has achieved, if the money has grown to a level, and that money, once it moves into fixed income, it is unlikely to decline substantially in value, but it is also unlikely to give you any extraordinary return. And that is a trade-off. That is what you do when you get closer to your goal. So gradually move your money to fixed income for a non-negotiable goal.
Okay. Mohammed has written in saying that, is it advisable to invest a lump sum of around 3 lakh rupees in small and mid cap funds for a period of 3 years?
Yes, it is advisable to invest 3 lakh rupees, but not at one go. Always spread. These small cap funds, they are very volatile. They're less volatile than many of the individual stocks, but compared to other funds, they could be very volatile. There might be an opportunity but 3 year time frame is not good enough. 3 year time frame is not good enough for equity itself. So I would say that if at all you are investing for a relatively non-negotiable goal and trying to take a chance on your investment for 3 years time frame, if you don't want to take chances, go for fixed income funds, or go for a very small allocation, maybe equity income fund or something which has a low allocation to equity. Only 10, 15, 20, 25% gets invested in equity there. So the likelihood of losing money is far lower than equity. There could be a time frame in equity market when over a 3 year time period you don't make any money. Maybe your money goes down in value. There was a phase not so long ago. In 2014, everybody was wondering what is long term. 2 years, 3 years in regular investment, and it has translated into no meaningful return. So there is a phase. So to generate return from equity, you need time. 3 years is not good enough.
So what do you say, 5 at least?
At least 5. And don't invest lump sum.
Okay.
Spread it over 8 months, 10 months, 12 months at least.
Okay. Ronak writes in, which of the two categories is better, large and mid cap or mid cap? I think the answer
is you find your comfort level. Mid caps will be more volatile. Large and mid cap will get you greater diversity. A third of the money is invested in mid cap. Remaining 2/3 is in large cap. So superior diversification. And I keep insisting that to keep it simple, you should have a more diverse mandate. So multi-caps, large and mid-cap, and value funds, which are also diversified vehicle, but following a different strategy, trying to look for undervalued stocks. these are the mainstream categories. They give you great diversification with simplicity.
Okay, fine. Ashim says, I have been investing in small and mid-cap funds since 2012. The returns as on date are not good. Should I exit at a loss?
I'm surprised that small and mid cap, because most the worst mid cap, small and mid cap fund, the worst fund would have given you a return of 10% annualized since 2012. Some mid, and the median return will be about 18%, 20%, could well be 25%. Yeah. So I'm very surprised.
So either which way, there's no loss.
I don't think so. He needs to, if he's investing since 2012, or if he invested in 2012 and if he's still at loss, I would like to have more information on this, which fund he invested in. And but this 6 years time frame, I can't imagine somebody has lost money, because I've looked at the looking at the list of funds and the kind of any time frame you would have taken, even if you have chosen to if accidentally you invested at the worst time in 2012 and try and sell it today, it will still translate into something substantial.
So should we advise Ashim that you write in with details,
with great
and perhaps
information on this?
We would be able to answer this better. Avinash says, I have been investing rupees 25,000 through SIPs in mid and small cap funds. Should I also do intermittent buying? My investment horizon is 10 to 15 years.
Yeah, investing 25,000 rupees in small and mid cap fund, and you think that periodically you have cash flows which are not of the regular kind. 25,000 rupees a month, I assume that it will be from your income which is getting invested. If periodically, then by all means invest regularly. 15 to 20 years time frame, investing in small and mid cap fund with great discipline, by all means keep doing it in any manner. Make sure that your intermittent investment is not a substantial thing, because I don't want, most investors have great, they panic when you invest at one go and things don't work out. If you invest, assuming that you are doing 25,000 rupees SIP, so in 3 years time you would have invested 9 lakh rupees, and your intermittent investment, if that happens to be 5 lakh rupees or 10 lakh rupees, then it is sizable. Spread that money. But if it is 50,000, 1 lakh rupees, and you think it is either you have the cash flow, you just got that earning, or you want to time it, generally I discourage investors to not attempt timing. But if you are investing with 10 to 15 years time frame, it doesn't matter. Keep investing intermittently as well.
Okay. Anand has written in, which is better among contra, value and mid-cap funds?
And multi-cap funds, yeah.
And multi-cap funds, and what should be the time horizon?
Time horizon of at least 5 to 6 years.
Okay.
And they're all good. They all follow the same similar strategy. They all invest in equity. The strategy is different. Most multi-cap funds will have substantially growth orientation. They'll be investing in companies which are likely to go up in value, because the companies are growing. It may not be cheap. Value funds are targeting to invest in those companies, or they invest in such companies which are out of favor.
Okay.
They are available at discount. So it's a completely relatively cheaper stock. Contra funds are, they may not be cheaper, but there could be special situation. Companies which are out of favor for some reason, and the market is unwilling. It could be a turnaround situation. So these fund managers follow a different school of it's a different style of investing.
Yes.
I would say that they all fit into a portfolio. If you are going to have 2 funds, I would say that invest a third of your money in a value fund, and invest 2/3 of your money in one multi-cap fund. That will do the job. If you are investing, if you are investing a large sum of money, maybe 2 multi-cap fund, 1 value fund will do the job. So I would say a third of money in value fund will work, because different segments of the market, they do well at different point of time. This is another level of diversification which investors should be aware of and should follow.
Okay. For a long-term horizon of 20 plus years, which is better, mid-cap fund or multi-cap fund? This is asked by Navroz. 20 plus years is quite a
yes. In fact, on value research online, you can look at the 10-year return and 20-year return, 10-year SIP return and 20-year SIP return of the mid-cap and the multi-cap fund. I would say that start with multi-cap. do it for 3 years, because it is not that mid caps and small caps will definitely generate more return. But I'm not very sure if investors can actually stick to it, because when you see that 2008 situation and investments go down in value by 70%, sticking to your own plan gets very difficult. So start with multi-cap, get used to it, make sure that you have 50-60% into small caps and mid caps. That's all right, but only after you have built up your gains, after you have experienced the market. Because over a period of time, over 15, 20, 25 years, what happens is that you see that your investment that you have made and the gains that it has earned, the component of investment is very small, and that gets you great comfort. Assuming that you are doing, if anybody would have done something like 25,000 rupee SIP over the last 20 years, that will be an investment of about 60 lakh rupees, 3 lakh rupees a year, 20 years, 60 lakh rupees. And this investment in a small cap fund will translate into something like 3.2 crore or some such amount. And when you see those kind of gains, maybe more, because I have seen situations where your contribution to the investment worth is just about 10-15%. So your risk tolerance actually goes up, because you think that my investment is so small and it has gone up in value so much over time that your belief is of a different kind. When you are not experienced enough, then your 100 rupee becoming 95 causes panic. When your 100 rupee has become 200 and you still don't believe in it, you are actually staring at that number with great disbelief. And when it comes down to 150, you panic. So, but when you see that your 100 rupee has actually become 2,000 rupees, and then it goes down in value by 100 rupee, you don't care. You have gotten used to it, and that time frame, that experience of investing, that is where it comes into play.
Yeah. Naveen has written, how are money markets and ultra short funds different? Which of the two are safer to invest for a period of 1 to 2 years?
Money market instruments are supposed to invest only in money market instruments, and they are very well defined that maturity of a certain kind, and the way they are valued, they never go down in value on a day-to-day basis. So they are ultra safe. They are unlikely, and even the credit quality is of a kind where you can be reasonably assured that.
How are the returns?
Little more than your savings bank account, far lower. Ultra short-term funds are, they can invest in maturity papers of maturity of about 6 to 9 months, and they can also take some, optimized return with some credit call, but that's about it. Investing for 1 to 2 years, ultra short-term bond fund or short duration funds could be the more appropriate way funds.
Mithun says, I'm 28 years old and started investing in an aggressive portfolio of mutual funds. Will it be right to expect a return of 20% over a period of 7 years?
I hope so, because and if this 20% does not materialize, if it turns out to be 18%, or if it turns out to be 17%, you won't be disappointed. Because these returns are, one has to look at equity return in a certain context. When looking at last 25 years, equity returns have been about 19%, 20%. But a good part of the last 20 years, 25 years has also been a phase where fixed income return itself was over 10%. You had 12%, 13% on RBI bonds about 15 years ago. So, and the inflation has been very high in India historically. So you have to look at it, inflation, and your fixed income should beat inflation, and equity should actually reward investors for assuming the risk, the equity premium on equity. So 20% was fine, is what we have earned in the past. But next decade or next 2 decades, if we earn 15%, and if interest rates are at 5%, and inflation is at 3%, I think we will all be much better off than the previous 2 decades.
We'll quickly take the last question. How can I create a monthly income of rupees 50,000 by investing rupees 50 lakhs, says Ignis.
Difficult, but not impossible, because this simply translates into 50,000 rupees a month, which is 6 lakh rupees a year, which on 50 lakh rupees translates into 12% return. So you may not be very
the horizon? He's not mentioned, but
he's not mentioned. But I'm thinking that 50 lakh rupees will be invested, and your need for income will be 50,000 rupees will be for all times to come.
Okay.
So if this 50 lakh rupees generates 12% return, you will keep making 6 lakh rupees a year, and your capital will remain constant. But that is actually half the problem. Your need for income will be to actually have higher income every year, at least in line with with inflation. Prices go up, and if you today you need 50,000 rupees, next year you might need 52,000 rupees. The year after that you might need 55,000 rupees. So that inflation adjusted need for higher income is a necessity. Then comes earning 12%, which is the most appropriate vehicle which can help you derive this return. I would say that equity income funds, but you are taking chances. It is not a guaranteed income. It is not like bank deposit where you get 8%.
Yeah.
And so you can invest 50 lakh rupees in those funds. Also, because 1/3 of that money is in equity, so you will have to average this investment, maybe 50 lakh rupees to be invested over the next 6 months, so that you are able to average a bit, because the initial blow, 50 lakh rupees invested and 3% decline, will be a massive blow emotionally for you. So averaging your investment in anything to do with equity is important for a person with these needs. I hope and invest in the growth plan. Implement mount a systematic withdrawal plan of 50,000 rupees, or maybe less to begin with. The ideal situation is that your withdrawal rate should be half as much, and only over time, when it goes up, that you should be able to revise your income. But if you necessarily need 50 lakh rupees, you run 2-3 risks. One is that your income will remain constant, because the capital will remain constant if you consume all the returns. In between, there will be occasion when your capital will go down in value. 50 lakh rupees might look like, if you mount a 50,000 rupees, 45, 48. But I still feel that if this is your need, and this is the capital that you have, and you can't accumulate more capital, you don't have a choice but to implement this.
Okay. Well, that's all we have in today's Investors Hangout. As the range said, do not panic, stay calm, and invest regularly. So till we meet next time, please stay calm. Bye for now.